Hey folks, welcome back. Getting into our 2023 performance reviews, trade strategy by trade strategy. Apologize, it's taken me so long to get them up. Had hard drive space issues, and then I had uploading issues, but you don't care about that. So let's go ahead and get right into it. Okay, so there's going to be a couple dozen of these videos coming out here over the next couple weeks. I'm going to try to get you one each evening, and that's because we have a couple dozen different strategies that we've deployed over a year's period of time. And this is good because we want to see obviously what results are. That's clearly important, but we also want to see what's working and what's not. And with regards to what's working, even though it is working, is there any way that we can enhance that? And then if it's not working, if it was a strategy that didn't produce results, positive results for us last year, is there something that we can do to fix it? Or do we just ditch it and go find something else to do? So very important retrospective here. And again, we do have quite a few different strategies that we deploy consistently, and there's actually a couple that I even forgot to put on here, but these are the main ones that we are working on week in, week out, month in, month out in our live trading room. And so just by happenstance, I happen to have the PowerPoint pulled up right now on the undefined risk credit strangles. So again, we'll put out a separate video for each one of these, and then I'll tag these videos as well, all in one video, so that you have one place that you can go and grab them all. But today we're talking about undefined risk credit strangles. And as we do this and go through all of these individual strategies, I think one thing that is important to understand is that in trading, just like in life, there are no panaceas. There's no silver bullets. There's no trade strategy that is all upside and no downside. I get this question a lot with newer members in our trading room. Hey, I just want to focus on the best strategy. I just want to focus on the go-to strategy. Well, look, if there was one best strategy, if there was one approach to trading that had all upside and no downside, that's all we would be doing, right? So I think it's important to remember that every single strategy out there has both pros and cons, and it's really about us individually as traders aligning the proper strategy with the proper underlying, right? Shorting can be a great thing to do. If you have been doing it with AI stocks lately, probably didn't work out too well. Doesn't mean shorting's not a good strategy. It just means that the strategy was not properly aligned, right? So every setup serves a purpose, and I think that's a critical thing. Now, one thing that I do want to note here is that this is not a training video on credit strangles, undefined risk credit strangles, and how they work and what the pros and cons necessarily of it is. I have a different video for that. I will tag that for you in the description as well if you're not familiar with them, or you maybe want to do some side-by-side comparisons, okay? But there are some unique pros and cons, and I just want to touch on a couple of the big ones here as we get started. So number one, to me, it's what I call a clean trade. So there's drag, and there's what we in the stock market refer to as slippage, and there's just essentially overhead in trading. And it's not just the commission that you pay to your brokerage firm. The stock exchanges also have fees that they pass along to us. And then, of course, everything that we trade has a bid-ask spread. And so if you are trading multiple contracts of multiple variations, maybe say an iron condor that has 4 different legs inside of it. That's not a clean trade. That's a cumbersome, expensive trade, overhead wise, fee wise, to get in and out of, to roll, to adjust, etc. And so there's really nothing that is as clean and easy to trade, get in, get out of, adjust, roll, what have you, than a naked put or a naked call. Something that doesn't have a spread involved with it. So it's a clean trade. The other thing that I always just tell people is, look, to each his own, and everybody has their own favorite trade, but it is what I would refer to it as a pro level trade. And what I mean by that is my short time that I spent on Wall Street, most of us were trading credit strangles. That's what most of us were trading. And of course we used other things as well, but the vast majority of us on the options trading desk were just basically putting on credit strangles and then managing the delta of them as things ebbed and flowed. So I've had the benefit of working with Tony Robbins in the past, and of course he's a big on mirroring, right? If you want to be successful at anything in life, find some, if you want to be really good at tennis, find somebody that's already good at tennis and, go do what they do. Mirroring other people is the shortcut to success. And so if you're a believer in that theory, like I am, I think it's notable that most professional traders are doing a lot, not necessarily all, but they're doing a lot. High percentage of their trades are credit strangles. As I said, it's commission friendly. And here's something that I think is interesting. And again, this is not meant to be a training video. You can check out the link in the description below for the training video. But trading a credit strangle, non-defined risk setup can give you a higher probability of profit. It can give you a higher chance of success than a defined risk trade, say a credit spread. People don't really realize that you can actually build a safer trade with an undefined risk setup than you can with a defined risk. Some of the cons, well, it certainly does take more buying power than a spread. No question about that. Now, people will list this as a con. To me, I kind of look at it as a benefit because, instead of saying, hey, you put up $15,000 to bring in X amount of money, with your credit strangle, with a spread, I only had to put up $3,000 to bring in the exact same credit. And that can be looked at as good or bad. People look at it now as a negative, meaning, hey, why would I put up 11 grand if I can do the same trade for 3 grand? Well, think about it for a minute. Why can you make the same amount of profit on a $3,000 trade as you can with an $11,000 trade? Leverage. There's actually more leverage in a spread than there is in a undefined risk trade. So I actually can take this and sort of view it as a positive, that we're actually putting more money up. We don't have quite the leverage. The other thing that is important, I think, to note is that in a undefined risk setup, whatever it is, it's the trader, not the trade, that needs to define the risk. And so let me be clear on this. Any trade of any kind can be a defined risk trade. They just vary on how that risk gets defined. Now, if you have a spread in place, you have sort of a built-in stop loss, right? And that's why it's defined. The amount of risk that you have is defined. In a naked position, selling just a put, selling just a call, doing a strangle, it is the trader that needs to define that risk. Same principle. It's just that risk is being managed and defined in a different manner. Okay, so any trade can be a defined risk trade, but for definitions, a credit strangle is undefined risk. Okay, so let's take a look at what we did in 2023, and this will probably hold true for most every one of the setups that we're going to go through. All of these setups here. Oops, there we go. All of these things right here, I think maybe without question are going to fall into this category where we did do some other ones during the year that are not listed here, but they were onesie twosies. They were sort of one-off trades. These are the ticker symbols that we traded undefined risk setups on every single week for the year. There were some earnings weeks so that we left out, but basically every week we were planning to do an undefined risk trade on those. So these are the ones that I'll focus on. Now, one quick thing, I'll let the cat out of the bag a little bit on this particular strategy setup and let you know that we did have, I would say, pretty good results last year with regards to those. And you can sort of see that illustrated here in that we're basically doubling this year how many undefined risk trades we are doing on a week in, week out basis. These ticker symbols may vary as the year comes and goes, but we've essentially doubled how many credit strangles we're doing this year versus last year. And one of the reasons for that is the introspective here of looking at our results and seeing the challenges that we had and saying, hey, this is a strategy that has high consistency of results and a lot of flexibility in being able to manage the positions that get threatened. And so maybe we should boost those up a little bit. So these are the ones that we're working on for 2024. But let's go through each one of these individually and talk about what our results were. So if we look at the first one, it's the IWM. And I really don't like hyperbole, and I don't like it, especially in trading, because I think we all understand that we can make money in the market. We also understand we can lose money, right? Excuse me. So, but nevertheless, we took a vote. This is now going on 4+ years ago, almost 5 years ago. We took a vote on what to call our IWM weekly credit strangle, and we came up with the IWM Millionaire Maker. And yeah, it's a little over the top, but you know what? I think it fits the bill. I think it fits the bill. It's a really impressive setup, and one of the reasons for that is that the IWM strangle setup that we have used now, again, over 4 years, probably 4.5 years now that we've been doing this week in and week out, has never, ever lost a single penny, ever. Now, that doesn't mean we haven't had rolls and we haven't had to add contracts here and there on occasion, but it's never lost any money. So that's a pretty rare feat. And if you look at what the IWM did in 2023, you can see that its price action was maybe a good part of why we had success with it. It was moving in a fairly definable range, albeit it was a decent sized range. But you'll notice that in these moves, even in this massive move to the downside here, you can see ebbs and flows. You can see where it stops and where it pauses on the way down. Same thing here as it went up. You can see that, there are pauses along the way. And if you are needing to roll or adjust trades on a week in, week out basis, which is how this setup works for us, those pauses are key. You'll see in a minute the Facebook or Meta trade that we did credit strangles on. That was not the case. It was more just straight up, and that made that trade a lot more difficult for us. But nevertheless, remember that you can skew a credit strangle, bullish or bearish. You could skew it in terms of the strikes that you pick. But generally speaking, the credit strangle is considered a delta neutral setup. So ideally, in a delta neutral setup, you would want a lot of this, right? You would want to just sideways motion, just flat motion. We didn't necessarily get that with the IWM, but it ended up being really successful for us. Now, I will just say on the IWM real quickly, Our goal with this trade for 2023, we've altered it for just a little bit here for 2024. Our goal was 1% return a week. Okay, so that should put us about 48% a year. Well, that's been the goal for the first 3 years that we've used this strategy here in the trading room. And so, if you just do quick math and you're saying, hey, 1% a week, there's 52 weeks in a year, you never had a losing week, shouldn't that be something like 52% return that you're going to bring in? Well, couple things obviously happen. Number one are fees and commissions, right? We've got fees that come into play here and commissions that we have to subtract. And then, of course, we're not taking a full profit every single week. Some weeks the trade will be green, it'll be profitable, but it looks like it's starting to get into trouble. We'll take a 30% capture, 40% capture. So we've never, ever been able to beat 50%. That's kind of our goal for the IWM credit strangle is 50% a year rate of return. We've never been able to beat that with the fees and the costs and the overhead and the taking early profits. So for 2024, we've done some changes here that I think will get us potentially over that hump, over the 50% return for the year. But let's look at our 2023 numbers. Okay, so first of all, right off. Okay, so for the IWM, for one contract, per contract, we grossed $1,802, $1,802 gross. We had $227 in commissions. We had $53 in exchange fees. Again, this is all per contract, all per contract. And the net return after the overhead was $1,522. Okay, again, per contract. Now, what does that equate to? Well, one of the things that you're going to see with all of the strategies that we go through here from last year's results is margin matters. So if you are on just standardized Reg T margin, you need to put up about $3,200, and again, that's per contract. Good grief, that's horrible. It's per contract, so $3,200 Reg T. If you're on portfolio margin, it only takes about $2,100. Okay, now, well, what does that matter? What's the difference? Well, it matters a lot because our results for 2023 with a Reg T margin account after fees and commissions was 47.5% rate of return. Not bad. Not the 50% return that we're looking for, but not bad. But it was a eye-watering 72% return if you were on portfolio margin. So again, margin matters. But either way, we're always thrilled with the IWM trade. Again, we're going into almost 5 years of doing this. We do it every week. We've never had a single losing week. And there's a reason why we call this the millionaire maker. And we'll look at some compound interest tables here in just a second. Screen's going crazy. So a couple of takeaways. Again, leverage matters. If you're on Reg T versus portfolio margin, big difference in terms of ROI or APR, however you want to look at it, on the exact same trade. Couple of other takeaways. Every year that I do these reviews and I add up all of the numbers, I'm always blown away at how expensive this trade is. Commissions, very, very, obviously, as you can see, right? That's a good chunk percentage-wise of what we grossed on the trade. So, commission-heavy trade. Dynamic adjusting helped. About halfway through the year last year, we started to dynamically adjust the IWM. We used to just leave it static, but put it on a Monday, take it off on a Friday. Put it on a Monday, take it off on a Friday. And then about halfway through the year, we started to dynamically adjust it, meaning we would roll in the untested side. That helped a little bit, but again, scaling is also a critical part of this. We want to be able to scale the IWM trade 1/3, 1/3, 1/3. So if it is going to take you, let's just use round numbers, if it's going to take you $3,000 of capital per contract to do this trade, you really need to have 9,000 of capital total set aside to do this trade, because we might scale the trade, a couple more times if needs be. I don't think we've ever scaled it 3 times. We've scaled it 2 times, maybe 3-4 times a year. We end up doing that. Okay, so having that ability to scale it, that's it's not. You say we do this trade every week, and we've never, for almost 5 years, and we've never had a losing trade. And you're like, okay, well, that can't be real. Well, of course we've had trades that didn't work, but we were able to roll them and do it at a credit and ultimately exit at an even higher profit. Well, you can't have that ability to adjust a losing trade if you're not scaling, right? So make sure that you have properly position size yourself. A couple other things that we are working on for this year that I'm really excited about. We've added a longer maturity date to help on the cost drag that the fees and the commissions are. We used to do 4 DTE trades, put it on a Monday. Sorry, I'm so dry throat here. Put it on a Monday, take it off on a Friday. We're now somewhere in the 7 to 9 DTE window. And that gives us obviously fewer turns, fewer commissions. So we are adding longer maturities. I think, again, we're really shooting for that 50+% return. Dynamic trading can be a double-edged sword. So we're very, very aggressive now in 2024 with our dynamic trading in terms of adjusting the untested side on a weekly basis and rolling it in and getting more credit from it. That's great. That's helping our premiums a ton. But it can also work against us, because if you roll it in, you lower the probabilities of success. If that now gets threatened, now you have another fee and commission to adjust it that you wouldn't have otherwise had. So it's really been an interesting study for us this year in terms of how dynamic is too dynamic in our trading. Being able to scale, again, 2 or more contracts to start, big help. If you can spread the commission cost over, again, this is not necessarily a cheap trade. You really, for the way that we do it, you need a minimum of $9,000 to do the trade, because you're going to start with about $3,000 and have the ability to scale it a couple more times. So if you can start with 2 or more contracts, if you had, say, 18,000 instead of 9,000 that you could properly position size for this trade, that helps immensely on cutting down the commission costs. Commission costs don't go up that much, but obviously you've doubled your premium, your credit, right? So those are some of the takeaways. Again, the power of compounding. This is why we call it the millionaire maker. If you were just to do 1 contract and do it for this every week for 10 years and could get 50% a year, that $3,200 grows to $184,000. If you could do it for 15 years, that $3,200 turns into $1.4 million. Now, one thing that you'll note in our other strategies that I go through with you here in subsequent videos, some of these trades are easier to compound than others, right? So in the case of the IWM, and again, let's just use round numbers. Let's say that you are using $3,000. We're not compounding this like interest in our savings account at the bank, where it's compounding daily, right? You're bringing in the income, but you can't really scale In fractional contracts, you need to go from one contract to two contracts, right? So it's going to take you about 18 months of building up income from this trade to be properly position sized to where you can say, yeah, now it's justifiable for me to start with two contracts instead of one. So anyway, solid trade. It's been a good one for us. The next one on the list is PayPal. Now, PayPal, again, these are credit strangles, generally considered delta neutral setups. You would prefer to have something sort of move like this. PayPal dropped from close to $100 to down below 50. Big move. To tell somebody, this is a huge victory for us, because to tell somebody that you made money off of a delta neutral strategy trading PayPal last year, we all would have probably been better off financially and mentally if all we had done was short PayPal all year. But nevertheless, we did do the credit strangle on it. Here's the number. We averaged about 5 contracts. Now, this is the hard part of going through and interpolating all of our data on a year in, year out basis. We don't always use the same number of contracts. So I try to get an average weighted number. That means that we would some weeks do 1 or 2 contracts, some weeks we do 9 contracts. Okay, but we averaged about 5 contracts on a weekly basis. And for 5 contracts, we brought in a gross credit of $2,469. We had some commissions and fees. Net after all of that overhead is basically $2,000 for those 5 contracts. We had to put up $7,000 for a Reg T setup for those 5 contracts, or $2,000 for a portfolio margin. On Reg T, that equates to a 28% return on portfolio margin, almost a 80% return. So again, if you look at the chart there and you say, this is what we wanted in this trade and this is what we got, you got to be pretty happy with those results right there. So pretty happy with the PayPal setup. Dynamic adjusting definitely helped there. We were adjusting this trade intra-week a lot. Scaling, very important. Again, I was as low as 1 and as high as 9 contracts on a week in, week out basis. Being flexible in maturities, there were many occasions where we had to go out 2 weeks. This is a weekly trade that we do, but we had to go out 2 weeks because that's where the premium sat. Quarterly earnings results, there were 4 quarters in the year. There's 4 earnings results. We would sit out most of those weeks. And so, we sat out 4 weeks. That's 1 month out of the whole entire year that our money was not in this trade working. But it's the right way to manage that risk. We have to risk off during earnings. Margin requirements, again, it's a big part, right? It depends if you're on Reg T or portfolio margin. But in either case, pretty darn good results. Much easier to compound this than the IWM. If you're trying to bring in more contracts and you say, hey, I'm going to start with 3 contracts, 4 contracts, and then I can scale to 5, and then I can scale to 6. And percentage-wise, you're not increasing that portion of your portfolio because you're only scaling with your profits. So it is a good trade. That worked out for us. Pretty happy with that one. Again, considering that it was a challenge for most of the year in terms of price action. But, the rule of 72, I do think that's an interesting number. And that 30%. 30% APR can double your value in every 2.5 years. In 10 years, that means that 10,000 can grow to $80,000. So just a side note here, guys, I think this is all we need. I know as traders, you can't log on to social media without somebody showing you their 1,000% gainer. And that's wonderful, I guess. But honestly, we don't need more than this. We really don't. If you can double your account in 3 years and you can do that consistently, no matter how little any of us are starting with, I think we'll probably be okay in the long run. So I always encourage traders. I'm like, you know what? We're going to build a trade that has a 10% return potential. Just this one trade, right? maybe over a 2 or a 3 day period, maybe a 4 day period. I would shoot for 2.5% a month total. That, I would shoot for around 30% a year, because that's pretty darn good. And it's a lot higher, obviously, than unmanaged approaches. The next one that I wanted to show you is the one that really was well, we had two that were challenging. This one was Netflix, and Netflix, of course, was a huge challenge for us. It started off in January right here. We were in trouble, and we chased it all the way up here. And then we thought we were pretty solid here, and then we ended up having to chase it all the way down here. And then it just absolutely took off like a rocket ship. And this was a good recovery period for us in here. But this push right here on Netflix put us in a situation where we were chasing this trade all year long. All year long, we were chasing this trade. So I'm thrilled with the results on the Netflix trade, because it was a challenge. For one contract, per contract, we brought in a little over $1,800 in credit. Take out our fees and exchange commissions, and that's what we brought in on per contract. This would be one contract. So the margin requirements for this on Reg T would be just under 18,000. Margin requirements on portfolio margin be 13,000. If you were trading with Reg T, that's a 9% return. Trading on portfolio margin, that's a 12% return. I'm thrilled with those results, guys, because it was a challenge. There were some very, very creative things that we had to come up with during the year to make the Netflix trade work. A couple things that we learned, takeaways. I think that it was too high of a price stock. One of the things that you'll notice this year, 2024, that we're doing with these credit strangles is trying to stick to lower price underlines so that it's easier to scale them. This was just too big of a stock to be able to scale well. Again, volatility helps and hurts. Certainly helped with the premium. We were getting great premium on it, but it also made it it made it so that we had to chase this trade almost all year long. Being creative with debit rolls. We had to roll when we were really getting pressed there on this move to the upside. We were rolling our call side of the trade at debits, and we were having to make it up on the put side with some creative spreads or other things. So being able to roll at a debit and then make it up on the unchallenged side, that's what allowed us to keep keeping pace with that charge upwards that it had. Again, margin requirements, big effect on what your end result is. And I think this is, for better or worse, going to be probably a big part of a lot of our strategy review videos for 2023. It's important to look at the big picture. It's easy to judge a trade that is working nonstop right off the bat, like the IWM. But when you have a trade that's not working, but it looks like it will, what do you do? Well, look, it's either working or it isn't. Maybe it's not working right now, but it looks like it will over the long haul. That's one of the reasons why we look at these on a year in, year out basis and not week to week. We can look at week to week. That's important. We need to know that. We need to know what potential drawdowns and things like that are. But ultimately, we've got to have a little bit longer term perspective. This trade looked bad for most of the year, and it ended up being okay for us. Last one that we worked on week in and week out was Meta. And man, Meta was probably the toughest. It was the hardest, I think, because while a lot of these other stocks had big moves, Meta's was just relentless. Just relentlessly higher. And again, remember, with credit strangles, we're really looking for more delta neutral trades. And so for our numbers with Meta, for one contract, we've grossed $400. Credit, fees and commissions end up netting $300, okay, per credit. 14,000, almost 15,000 margin requirement for Reg T, 4,300 for portfolio margin. That's a whopping 2% return for Reg T and a 7% return for portfolio margin. This is another trade where I think it was, obviously we started the trade in January. It was November before this trade started to show green. So again, every week I would say the same thing. The trade's working. We're bringing in credit. It's moving in the right direction. Still not profitable. But we saw the light at the end of the tunnel. So we stuck with it. And, I'm happy that at least it was a green number. Not a great number, but a green number. Anyway, just happy to end on a green number. Here's a little shocker for you. Not all of them are going to be green, right? We have losers as well as winners. So I'm pretty happy with the decision making that we made to stick with the trade, because we could have easily just cut our losses, had a big red number there, but we didn't. We persevered. Couple takeaways from the meta setups. Tech's tough. I think we're seeing that here again in 2024, that technology is tough. And it's there's a lot of volatility in that area, especially now with AI. Scaling ability, again, was low, very expensive stock, hard to scale it. Being flexible on maturities. We in some cases were taking what started as a 1-week trade out 60 days. We were rolling out 60 days because that's where we needed to go to get the credit to be able to stay with that big, massive move. Being stuck through two earnings cycles made it harder. We were stuck in positions that we felt from a risk reward standpoint, it didn't make a lot of sense to stay in the trade as earnings were going to be announced, but it didn't really help us that much to exit. So we got stuck in a couple of those. It probably added 8 weeks, 9 weeks to our cycle of getting back into the green. Margin requirements, again, big factor. 2% is okay. 7% is really okay. It's a lot different, right? Big difference percentage wise. So again, margin requirements. Hi, buddy. Margin requirements. This is my trading buddy. Margin requirements greatly affect results. And then the other, I think, bottom line takeaway for us is that there's probably better risk reward candidates out there. There's probably better choices out there for us to trade. We've gone through this same experience with Tesla. You would think Tesla would be a great stock to do a strategy like this on. Not great risk reward. Not great risk reward. So those are some of the takeaways from that. That is our review for our weekly credit strangle. Ended up pretty good for us, I think, for the last year. Again, we have doubled the number that we're using this year. So pretty excited about that. If you are interested in becoming a member, becoming part of our trading community, I would love to touch base with you. You can go to tradelivewithus.com, sign up for a month. You and I will have a Zoom session. We'll touch base every single day for that month's period of time. If you go through the 4 hours of training that I give you, if you go through the one-on-one orientation that I give you, if you do your daily check-ins that we will have, and you do not feel like this is the best value-oriented trading room online today, no questions asked, I'll give you double your month subscription back. So check us out. I think you'll like it. Okay. Appreciate you guys. If for whatever reason you don't want to engage with a live trading community, but you want to have some input on trading strategies, setups, or just what it takes to move into trading full time, perhaps, had a lot of those questions lately, you can go to askyourtradingquestions.com and we can engage each other there. One other thing that I will just share with you quickly here, I don't want this video to be too long, but every single day we are doing market analyses and putting up our intraday trading levels on the leveltoleveltrading.com website. So check it out. Every single day we post a new update there. And yeah, it's been getting a lot of good traction. It's free. Go check it out. Okay. Also, if you want to get in touch with me, you can go to Scott Stewart Contacts. You can get a hold of me in a lot of different ways. So that's it, folks. Appreciate you. That's the Credit Strangles. Again, I just really appreciate the YouTube community, and I appreciate all of you that on a daily basis are trying cumulatively to help all of us become better traders. So appreciate you guys. I appreciate your support, and yeah, we'll get you another video out here later this evening on our next strategy. So thanks, guys. Take care.